Hello viewers, welcome to the last lesson on law of investments and securities. In this lesson, we will learn about the miscellaneous issues relating to the investments and securities. Objectives: to learn about various issues relating to the stock exchanges and stock markets. To learn about various issues relating to the investments and securities which were not discussed earlier in other lessons. Viewers, now we will learn about various issues relating to the stock exchanges and stock markets. 1. Stock exchange. Stock exchange is a marketplace for trading the securities. Under Clause J to Section 2 of the Securities Contracts Regulation Act 1956, stock exchange is defined as any body of individuals, whether incorporated or not, constituted before corporatization and demutualization under sections 4A and 4B, or a body corporate incorporated under the Companies Act 1956, whether under a scheme of corporatization and demutualization or otherwise, for the purpose of assisting, regulating, or controlling the business of buying, selling, or dealing in securities. The stock exchanges are the subject matter of several corporate legislations like the Companies Act 2013, SEBI Act 1992, Securities Contracts Regulation Act 1956, the Depositories Act 1996, etc. The stock exchanges are regulated by the Securities and Exchange Board of India. The stock exchanges play a pivotal role in the national economic development. In India, two major stock exchanges are functioning, namely the National Stock Exchange, called in short NSE, and the Bombay Stock Exchange, called in short BSE, apart from other stock exchanges like the Calcutta Stock Exchange, the Pune Stock Exchange, and others. They are explained hereunder. National Stock Exchange. According to the official information drawn from the NSE website, the National Stock Exchange is the leading stock exchange in India and the fourth largest stock exchange in the world by equity trading volume in 2015, as per the information from the World Federation of Exchanges. It was incorporated in the year 1992 by a set of leading financial institutions, banks, insurance companies, and other financial intermediaries in India. It was recognized as a stock exchange by SEBI in April 1993. It began operations in 1994 and is ranked as the largest stock exchange in India in terms of total and average daily turnover for equity shares every year since 1995, based on annual reports of SEBI. It was further ranked as the fourth largest stock exchange in Asia and the 11th largest stock exchange in the world. It deals with several kinds of securities. NSE launched electronic screen-based trading in 1994, derivatives trading in the form of index futures, and internet trading in 2000, which were each the first of its kind in India. NSE has a fully integrated business model comprising exchange listings, trading services, clearing and settlement services, indices, market data feeds, technology solutions, and financial education offerings. NSE also oversees compliance by trading and clearing members and listed companies with the rules and regulations of the exchange. NSE is a pioneer in technology and ensures the reliability and performance of its systems through a culture of innovation and investment in technology. NSE believes that the scale and breadth of its products and services sustain leadership positions across multiple asset classes in India and globally enable it to be highly reactive to market demands and changes and deliver innovation in both trading and non-trading businesses to provide high quality data and services to market participants and clients. It won several awards. It has several subsidiaries for various purposes. The purpose of NSE is committed to improve the financial well-being of people. The NSE's corporate office is situated at Bombay and it has branches in several big cities. The main index of NSE is called S&P CNX Nifty. B. Bombay Stock Exchange. As per the information drawn from the official website of the BSE, it was established in 1875. BSE was formerly known as Bombay Stock Exchange Limited. It is Asia's first and the fastest stock exchange in the world with the speed of 6 microseconds and one of India's leading exchange groups. Over the past 140 years, BSE has facilitated the growth of the Indian corporate sector by providing it an efficient capital raising platform. The BSE was originally established as the Native Share and Stockbrokers Association in 1875. BSE is a corporatized and demutualized entity with a broad shareholder base which includes 2 leading global exchanges, Duty Bourse and Singapore Exchange, as strategic partners. BSE provides an efficient and transparent market for trading in equity, debt instruments, derivatives, mutual funds. It also has a platform for trading in equities of small and medium enterprises, SME. More than 5,500 companies are listed on BSE, making it world's #1 exchange in terms of listed companies. The companies listed on BSE command a total market capitalization of USD 1.64 trillion as of September 2015. It is also one of the world's leading exchanges, 5th largest in September 2015 for index options trading, source World Federation of Exchanges. BSE also provides a host of other services to capital market participants, including risk management, clearing, settlement, market data services, and education. It has a global reach with customers around the world and a nationwide presence. BSE systems and processes are designed to safeguard market integrity, drive the growth of the Indian capital market, and stimulate innovation and competition across all market segments. BSE is the first exchange in India and second in the world to obtain an ISO 9001-2000 certification. It is also the first exchange in the country and second in the world to receive information security management system standard BS 7799-2002 certification for its online trading system. It operates one of the most respected capital market educational institutes in the country, the BSE Institute Limited. BSE also provides depository services through its Central Depository Services Limited, CDSL, BSE's popular equity index. The S&P BSE Sensex is India's most widely tracked stock market benchmark index. It is traded internationally on the Eurex as well as leading exchanges of the BRICS nations, Brazil, Russia, China, and South Africa. BSE has won several awards and recognitions like India Innovation Award for the big data implementation, ICICI Lombard and ET Now Risk Management, BFSI Company 2013, Squawk Order of Merit Certificate for E-Boss for qualifying amongst India's Best 2013, the Golden Peacock Global CSR Award for its initiatives in corporate social responsibility, NASSCOM CNBC TV 18's IT User Awards 2010 in Financial Services category, Squawk Virtual Corporation 2010 Award in the BSE Star MF category, and Responsibility Award CSR by the World Council of Corporate Governance. Its recent milestones include the launching of BRIC Smart Indices derivatives, BSE SME Exchange Platform, S&P BSE GreenX to promote investments in Green India. The main index of BSE is called BSE Sensex. Sensex. Very often we hear about the fall and rise of Sensex, which is linked with various socio-economic and political developments in India and also in the world in general. The Sensex is also called as BSE 30 and also the S&P BSE Sensex, that is S&P Bombay Stock Exchange Sensitive Index. It's a free float market weighted stock market index of 30 well established and financially sound companies listed on the Bombay Stock Exchange. The 30 companies are representatives of various industrial sectors of the Indian economy. It is published since January 1, 1986, and it is regarded as the pulse of the domestic stock markets in India. Presently, the BSE is also publishing a dollar-linked version of the Sensex called Dolex 30. The Sensex is based on market capitalization weighted method. The base year is taken as 1978-79. The Sensex today is widely reported in both domestic and international markets through print as well as electronic media. It is scientifically designed and is based on globally accepted construction and review methodology. Free floating capital implies total capitalization less directors' shareholding. Nifty. Nifty is also like the Sensex, a stock market index. It is the stock market index for NSE comprising of 50 stocks. It is also called Nifty 50. This term is coined by joining the words national and 50, which refers to the 50 active company stocks it comprises of. It is an indicator of the 50 top major companies on the NSE. Nifty is calculated by the same methodology, but with two major differences, that the base year is 1995 and the base value is 1000. It gives the price movements of top 50 scrips listed on the NSE. The Nifty and the Sensex both serve as indicators of the country's economic trends. If these indices are going down, it is an indication that the economy is falling. Viewers, now we will learn about various miscellaneous issues relating to the investments and securities, which were not discussed earlier in detail in the other lessons. 1. Insider trading. Insider trading means the trading in the securities of a company by the persons who are in the management of the company or are close to them on the basis of undisclosed price-sensitive information regarding the working of the company which they possess, which is not available to others. It is a breach of fiduciary duty. This is prevalent among the investors all over the world. On insider trading, As back as 1940, the government appointed Thomas Committee in India to evaluate the restrictions which can be imposed on short swing profits made from insider trading. In this connection, sections 307 and 308 were incorporated in the Companies Act 1956. For more stringency of law against insider trading, the SEBI Insider Trading Regulations 1992 were passed. Subsequently, the SEBI Prohibition of Insider Trading Regulations 1992 were brought into force, while amendments in 2002. Presently, the SEBI Prohibition of Insider Trading Regulations 2015 are in operation. Section 195 of the Companies Act 2013 contains detailed provisions on insider trading and prohibits it, and the offenders are liable for punishment of imprisonment for a term which may extend to 5 years or with fine which shall not be less than 5 lakh rupees, but which may extend to 25 crore rupees or 3 times the amount of profits made out of insider trading, whichever is higher, or with both. 2. Investors' protection. The investors need protection from various malpractices and unfair practices made by the corporates and also intermediaries. In this regard, the investors are vested with multiple rights as shareholders and debenture holders. The Companies Act and also the SEBI Act provided several provisions and guidelines in respect of investors' protection. The BSE and the NSE also provide the mechanism for redressal of investors' grievances. Further, the RBI, the MCA, the IRDA, FMC, PFRDA, CCI, Registrar of Chit Funds, the National Housing Bank and the SEBI act as regulators for redressing the grievances of the investors. In this connection, sections 34, 36, 38 relating to the misstatement in prospectus, sections 56 to 59 relating to the transfer and transmission of securities, section 71 relating to protection of debenture holders, sections 73 and 74 relating to the acceptance of deposits by companies. Sections 123 to 125 pertaining to payment of dividend. Section 136 relating to obtaining the copies of balance sheet and auditor's report. Section 436 relating to various issues of investors under the Companies Act 2013 are noteworthy. Sections 11, 15A to 15HA and 24 of the SEBI Act also provide the necessary protective provisions for investors' protection. The SEBI also notified several guidelines for investors' protection. The SEBI also notified regulations for investors' education along with the MCA. The MCA took similar steps under Section 125 of the Companies Act 2013. Sections 23, 23A, 23H and 23M of the Securities Contracts Regulation Act 1956 also contain provisions on investors' protection. Section 45QA of the RBI Act 1934 also provides protection for investors. Today in India, the investors are better secured and protected than the earlier times. Students are advised to study other corporate laws also in this regard. Takeover Code. Takeover Code is the code of SEBI for a systematic framework for acquisition of stake in listed companies. This regulatory system protects the interests of the shareholders in case of an acquisition or takeover. This code ensures that the shareholders are treated fairly and equitably by offering them mandatorily an exit opportunity from the company at the best possible terms in case of a substantial acquisition in or change in control of a listed company. The SEBI has made several regulations in this regard, and presently the SEBI Substantial Acquisition of Shares and Takeovers Regulations 2011 are in operation. These regulations aim at the protection of the investors and a fair deal. Depository receipts. Depository receipt is a negotiable instrument evidencing a fixed number of equity shares of the issuing company, being an Indian company, denominated in foreign currency and is being traded in foreign exchanges. This is a tool to have access to global capital markets. This is related to Euro issues. Euro issues mean modes of raising funds by an Indian company outside India in foreign currency. The globalization offers an opportunity to companies to tap a new investor base. The Indian companies are allowed to raise equity capital in the international arena by issuing global depository receipts, American depository receipts, foreign currency convertible bonds, and foreign currency exchangeable bonds. The depository receipts include the American depository receipts and global depository receipts. The law governing depository receipts is embedded in the foreign currency, convertible bonds and ordinary shares through Depository Receipt Mechanism Scheme 1993, Foreign Currency Exchangeable Bonds Scheme 2008, Section 41 of the Companies Act 2013, and the relevant rules thereon, especially the companies, issue of global depository receipts, Rules 2014, the various notifications, circulars of Ministry of Finance, GOI, the FDI policy of GOI, the RBI regulations and circulars, listing agreement and other provisions, rules and regulations under other corporate laws, and also the FEMA. The American depository receipt is a dollar-denominated form of equity ownership in the form of depository receipts in the non-US companies. It represents the foreign shares of the company held on deposit by a custodian bank in the company's home country and carries the corporate and economic rights of the foreign shares. They are traded in USA. The global depositories receipts, GDR, are used in Euro market and US market. Listing of these receipts may take place in international stock exchanges like the London Stock Exchange, New York Stock Exchange, American Stock Exchange, Luxembourg Stock Exchange, etc. The depository receipts are issued as negotiable securities issued outside India by a depository bank on behalf of an Indian company which represents the local rupee denominated equity shares of the company held as deposit by a custodian bank in India. In common parlance, the depository receipts listed and traded in the US markets are known as American depository receipts, and those listed and traded elsewhere are known as global depository receipts. In India, the depository receipts are treated as foreign direct investment, FDI. The students are hereby advised to thoroughly study the various rules, regulations, guidelines of the SEBI and also MCA relating to the above discussed subjects, along with the substantial law. Further, they may also read the comparative foreign law, especially in the countries like USA, UK, Australia, Japan, Germany, China, Sri Lanka, and the Gulf countries to update themselves with the global developments pertaining to the laws on investments and securities. Well, viewers, I hope you have enjoyed all the lessons of this subject. I wish you all the best. Thank you.